Hello everyone, and welcome. My name is Bob Durante, and I'm a Senior Director at S&P Global Market Intelligence, managing the Americas Risk Solutions team within Risk Services. It's my pleasure to moderate today's video. Today's video, we will address two fundamental challenges in assessing the creditworthiness of banks. First is having the right data. Second is having the best credit scoring tool available. Now, we'd like to briefly introduce my colleagues. Jessica Bennett, Senior Product Manager in the S&P Global Market Intelligence Industry Product Management Group. Jessica is responsible for the financial institution's S&L product suite, including our bank data sets. I'd also like to introduce Rad Lukic, Director, S&P Global Market Intelligence. Rad is currently the analytical lead in the team on developing and managing credit risk scoring methodologies, including our Bank Scorecard, and as you know, a regular panelist on Risk Insights video series. Thank you, Jessica and Rad, for joining us today. Now let's get started. Today's agenda will focus on three broad topics. First, we will discuss the importance of having the highest quality data when evaluating the creditworthiness of a bank. Second, we will explore one example of a solution that can help face the challenges of this volatile credit climate. Third, in a case study format, we will demonstrate how the marriage of S&L Financial Bank Data and S&P Global Market Intelligence Bank Scorecard can confidently and conveniently help you assess the creditworthiness of your bank exposures, including identifying early warning signs of deteriorating bank credit quality. Before we begin, for those of you who still know of us as S&P Capital IQ or S&L, I want to briefly introduce to you S&P Global Market Intelligence, bringing together the highest quality data and industry-leading solutions from S&P Capital IQ and S&L Financial. S&P Global Market Intelligence integrates news, comprehensive market and sector-specific data and analytics into a variety of tools to help clients track performance, generate alpha, identify investment ideas, understand competitive and industry dynamics, perform valuations, and assess credit risk. Every day at S&P Global Market Intelligence, we collect, scrub, interpret, and analyze vast volumes of content, turning it into actionable intelligence on the global financial markets and companies and industries that comprise those markets, enabling our clients to make smarter business decisions, especially now that they have the option to leverage the best of both worlds. A strong example of this is the powerful synergy of the marriage of S&L financial data and Bank Credit Assessment Scorecard. I think everyone watching understands the importance of quality data when analyzing credit quality, but I think one of our clients recently said it best. You don't want to buy a Ferrari and put cheap fuel in it. Why buy a sophisticated scoring engine and then feed it with erroneous data? Good data is the key to improving the accuracy of the outputs from the scorecard. So Jessica, my client experiences with S&L bank data suggests that the market really trusts the data that S&L provides. In your opinion, what drives that trust?
I could probably use the full 20 minutes of our video just to answer that question. But perhaps sharing our client profile will help provide some insight into our banking expertise and reputation. Our client footprint extends to every continent, including commercial banks and investment banks, 27 of 30 globally systemically important banks, and major banking regulators. S&L has been providing banking-specific data to the market for over 30 years, so the company has built up significant expertise in the space.
Bank data could be complex. What type of adjustments does S&L apply to its bank data?
S&L standardizes its data across countries, accounting treatments, languages, and currencies. The product offers specialized, industry-specific financial metrics built using industry-specific templates, so you won't spend time trying to make bank-specific adjustments to a more generalist financial statement. S&L typically publishes public bank financials from the earnings release within 8 hours and the 10Q, 10K within 24 hours. Data from the U.S. bank regulatory filings are available within the product within 24 hours. In the U.S., commercial and savings banks are required to report granular, standardized reports to the U.S. regulatory agencies every quarter. These regulatory filings are often available prior to public filings of the bank holding company, giving you an early warning indicator of risk and deterioration of credit quality.
In today's heightened regulatory environment, having transparent data is essential. Many of our clients spend countless hours spreading financials and building out ratios that could be better spent elsewhere. Is there a way that S&L can help risk management teams understand the source of the underlying financials?
First, get quick access to source documents. For example, users of the scorecard can click on a liquid assets number and see the original source document in its original language or translated with the exact line item highlighted. Users can also see the components of a calculated item to identify what's driving the underlying result.
Speaking of liquid assets, are there specific reasons why the S&L data is a recommended driver of the S&P Global Market Intelligence Bank Scorecard, along with data from S&P Capital IQ platform?
Absolutely. S&L's industry-specific financial coverage allows us to provide data points that aren't available in other providers. For example, S&L does not just collect Tier 1 capital under Basel III. We collect regulatory capital ratios under the many different approaches, including standardized or advanced, traditional or fully loaded under Basel I, 2.5, and 3 capital regimes. We will always calculate key risk ratios in the event that they are not directly reported. S&L also utilizes its knowledge of the bank regulatory space to offer a more objective definition for what are sometimes subjective metrics, such as liquid assets, by leveraging guidance published by the U.S. regulatory agencies.
Thanks, Jessica. Great overview of the S&L Bank data, which I know is especially important for many of our viewers who in general manage low default portfolios that by definition lack the extensive internal default data necessary for the construction of statistical models that can be robustly calibrated and validated. Now, Rad, let's focus first on the S&P Global Market Intelligence Scorecards and then specifically discuss the Bank Scorecard. So, Rad, tell us about the scorecards.
Sure, Bob. The scorecards are expert judgment-based credit scoring tools. They help credit analysts objectively assess and combine financial statement data and also qualitative information to arrive at an aggregate risk score for an obligor. Because the methodology underlying each scorecard is broadly aligned with the S&P ratings methodology, the output of the scorecard can robustly be mapped to an S&P global ratings grade and also an institution's own internal rating scale.
Rad, you mentioned qualitative risk factors. Can you show me an example?
Sure. Well, we know that best practices of rating systems suggest using qualitative expert judgment-based risk factors in addition to quantitative ones to effectively capture the heterogeneous credit risk nature of complex sectors such as banks. And this is also the way scorecards bring in the forward-looking opinions about how the current creditworthiness of an obligor is likely to evolve from the position observed in the most recent financial statements. And we can also say that a key shortcoming of strictly quantitative models is their bias towards the variables that tend to reflect the easily quantified phenomena and the ones for which available data are abundant. So what happens is that this can leave out some important drivers such as risk appetite, complexity, and loss experience that aim to capture the management's tolerance for risk and willingness to accept higher complexity. And also things like financial flexibility that tend to give us some information about availability of funding in a stressed market condition.
Thanks for describing some important qualitative bank risk factors. Now, can you share how our clients can achieve the analyst-to-analyst and year-to-year consistency in scoring those elements you just mentioned?
Sure. Well, qualitative factors present some challenges in terms of criteria for the consistent and replicable assessment, since we know that there is a risk of multiple or different interpretations of the same judgmental concept. And the answer to this challenge is in defining in a very detailed, consistent, and objective manner how these factors should be evaluated. And as you can see here on the screen, this is an example of a qualitative scoring guideline for a factor where we identify the detailed attributes associated with each risk assessment level. So for this risk factor, actually due to space constraints, we are sharing only 3 of the 7 potential scoring levels that range from very strong to very weak. But these scoring levels are mapped to quantitative adjustments to risk scores. So the score, very weak, could actually result in a downward notching of the entire risk dimension by, for example, 3 notches.
Using the bank scorecard as an example, how does the scorecard help practitioners streamline their workflow?
Well, this is where integrating the bank scorecard with SNL banking data comes into play. We automate the spreading of financial ratio data using Excel plugin feature, ensuring a powerful scoring convenience for users. We also automate the application of country-specific economic and banking industry risk assessments, drawing from S&P's sovereign and banking industry country risk scores. So to illustrate this, the bank scorecard with SNL data with a plugin feature was designed to automatically spread the financial data in the bank scorecard for around 90 or so countries, where we have pre-populated the banking industry and country risk scores from S&P. And now, by using simple drop-down menus in Excel, all you have to do is identify the country, name of the bank, currency you want to display the results in, and the fiscal period you wish to use for the scoring process. And then, with one click, the data is going to be automatically refreshed.
That is fast and convenient. Now it's time to transition to the third topic of today's video. In a case study format, we will demonstrate how the marriage of SNL financial data and the bank scorecard can help you recognize, at an early stage, weakening bank credit quality. Over the years, we observed that bank credit quality could deteriorate quickly. So it's essential to have a set of tools that can help you build a credit life cycle workflow process, taking you from origination through loan approval and include portfolio monitoring and surveillance. In our next section, we would like to demonstrate how you can apply a tool like the bank scorecard to your workflow. For our case study example, we selected a $140 million bank in southern New Jersey called Harvest Community Bank. They specialize in lending activities to commercial real estate and small businesses. In other words, they have a similar profile to hundreds of community banks across the United States. Jessica, by conducting a search of Harvest Community Bank using SNL bank data, what could we learn?
Quite a bit. So for example, Harvest Community Bank is publicly traded on OTC Pink Sheets and has some of the highest Texas ratios in the industry. Texas ratios are non-performing assets plus loans 90 days plus due as a percentage of tangible equity and loan loss reserves are a good measure of a bank's ability to absorb future losses and are proven to be correlated with bank failures. I can also tell this bank is undercapitalized. It was one of only 17 banks to report common equity Tier 1 ratio below 4.5%, the minimum required by US regulators, in the first quarter of 2016.
Given the profile that Jessica provided, what would you be looking for when you conduct your credit analysis on the bank?
Sure. Well, first of all, I agree that there are strong early warning signals related to the loss absorption capacity and also capitalization levels indicated by Texas and Tier 1 ratios, for example. But the S&P Bank Scorecard has a risk section devoted to capitalization and earnings, measuring a bank's ability to absorb losses. So, in addition to capitalization metrics, I would also be looking towards the risk factors in this section that focus on assessing the earnings capacity, because this is the first line of defense against losses and sort of the primary way that a bank builds or maintains its capital. So that earnings buffer actually showed significant deterioration for this bank, dropping from what we call a moderate level as assessed by the scorecard using financials 2 years back to a very weak level in the most current assessment.
Jessica, what type of alerts can we set up with SNL bank data to allow us to monitor Harvest Community Bank closely?
There are several options. In this case, I think what works best is a combination of our credit risk dashboard and email alerts for news and documents. Our credit risk dashboard shows CDS and stock price moves, as well as streaming news for your covered companies, all in one page. Our news and documents and email alerts can be customized to a list of companies and specific document types like press releases or quarterly filings. Most helpful, at any time your covered companies are mentioned in our industry research, you'll be alerted. SNL also publishes periodic articles highlighting banks that are undercapitalized, have high loss rates, poor earnings performance, as well as banks that have been issued enforcement actions by their regulator. This banking-focused news coverage complements the credit analysis done leveraging the Bank Scorecard.
Now it's time to drill down into the scoring process for Harvard Community using the SNL Bank Data and S&P Global Market Intelligence Scorecard. Using the SNL data through 2013 and the SNL plugin, we ran the scorecard and generated a risk score of BB. We then ran the scorecard using data through 2015 and generated a score of CCC-. That is a 7 notches decline in 2 years, which is quite substantial. Rad, what does a deterioration of this magnitude mean, and why does it matter?
Yeah, well, quite a lot. I mean, given, first of all, the broad alignment of our scorecard with the S&P Bank Global Rating methodology or criteria, we can then map the scorecard outputs to not only the S&P rating grades, but also the observed default rates associated with these rating grades. And as indicated on this graph, the more than 6-notch decline that we observed in the credit quality has actually accelerated the likelihood of default exponentially. And specifically, the 1-year default rate that you mentioned for a BB is more than a 0.5% probability of default, whereas a default rate of CCC- is a alarming 23.7% default probability.
Jessica,
what happened at Harvest Community Bank that caused such a rapid decline in credit quality?
This appears to be a case of inadequate risk management processes. According to a 2015 consent order from the bank's regulators, Harvest Community Bank has extended credit to borrowers without the ability to repay and comply with the terms of their loans. This has resulted in growing charge-offs and non-performing assets. These unsound lending practices impact all aspects of the bank's performance, including declining earnings, Basel III ratios, and reduced access to capital and liquidity.
Jessica, how can institutions be proactive in managing the credit risk for banks?
The alerts that we set up would notify us not only of the availability of new financial data as soon as it was released, but the relative standing of Harvest Community Bank compared to other banks as in the industry as a whole via SNL data dispatch articles. Monitoring new financial information and understanding a covered company within the context of industry trends helps manage risk.
In addition to the Texas ratio we mentioned earlier, Rad, what other early warning signs could we flagged when we conducted our credit review for Harvest Community Bank using data through fiscal 2013?
Okay, so 2 years back, what jumps out in reviewing 2013 data are the already weakening profitability metrics. So as I mentioned, we have found that these profitability metrics could be useful early warning indicators. And in addition to banks' relative dependence on central bank funding and its ability to access other liquidity sources is also an important qualitative early warning sign. We often see how liquidity becomes progressively weaker as an institution increasingly relies on funding support from monetary authorities, and that's what we see here. And we also started seeing a deterioration of standard liquidity ratios, such as liquid assets to wholesale funding and liquid assets to deposits.
When you compare the fiscal 2013 results with the 2015 results, where have the biggest changes occurred?
Well, across the board, there was a weakening in all areas, but most notably the capital ratios and earnings for Harvest Community Bank. At the same time, the liquidity position also weakened significantly, indicating a deterioration of liquid assets.
For a weak credit like Harvest Community Bank, at what frequency would you surveil this bank?
Well, the SNL plugin enables a seamless process to update the financials as they become available, so at least quarterly. But for Harvest Community Bank and other banks in this situation, we would suggest closely monitoring the liquidity, earnings, and capital ratios.
Right, I noticed the stock price for the bank is trading at 20 cents, way off its 52-week high of $1.01. Does this concern you?
Yes, absolutely. We do believe that when assessing credit risk, a multi-dimensional perspective is best. So with the stock price trading near the 52-week low, this does confirm there's a strong negative market sentiment. So when you overlay the negative market sentiment for Harvest Community with the scorecard assessment deterioration, indicating heightening of default risk, there clearly is going to be a strong relationship worth noting.
Well, that's all for today. For Rad and Jessica, thank you for watching.